Hello, everyone. This is Todd Brauch with Senior Insurance Marketing. And on our webinar today, we're going to talk about annuities, and we're going to talk about income annuities and some of the other features about annuities. And with us here today, our partners to help us with annuities is Rook. And we are going to talk about how individuals can, not outlive their income and their money and everything like that. So without further ado, Rick, can you tell us more about annuities and also the great features that annuities offer for clients as well?
Absolutely. And Todd, thank you for letting us join in as one of your annuity partner relationships to be able to help train, educate. So we are a support team. Myself, Todd Weiss, we are the annuity division. And so if you have questions, concerns, needs, illustrations, we're agents in the field. We like to say we are not travel agents selling you brochures to places we've never been. Todd and myself and Mark, we all are agents in the field. I'm working on about 1.5 million right now. I know Todd usually has been tracking between 1.5, 2 million a year. And so our goal personally is to try to double our income each year by just adding annuities. Now, keep in mind, I'm full-time in the office doing webinars all day long, but I had someone call me this morning, and because I'd had a dinner with them and I had mentioned and reminded them that, hey, what do you do? Well, I'm a retirement income specialist. And so I make sure that everyone knows that I'm a retirement income specialist on every call. Hi, I'm Rick. I'm a retirement income specialist. I'm here to talk to you about your med sups, your Medicare Advantage, your hospital indemnity. I'm here to talk to you about your life. I'm here to talk to you about final expense or your cancer, your dental plan. I'm Rick. I'm the retirement income specialist. I'm here to deliver your Grubhub. I'm here to deliver your pizza. I'm here to check your dog for fleas. I don't care why you are there. Make sure that everyone that you meet knows and that they hear you say it often, several times throughout the conversation. I am a retirement income specialist. As a retirement income specialist, when I'm helping my clients with their med subs, when I'm helping my clients with their med advantage, when I'm helping my clients with their life insurance and their final expense. Because if you say that often enough, it'll be just like what happened to me this morning. Hey, Rick, the other day we were visiting and you mentioned that you're a retirement income specialist. You mentioned some accounts that are doing really well right now. What do you have that you could help me with? I've got this old account. It's probably getting 2-3%. Can you do anything better? It seemed like you had some better upside potential. So I just want you to constantly, please don't forget on every call, every introduction, whether it's on the street, at a lunch, to the clients, to the leads that you're dealing with, make sure you're the retirement income specialist on every call. I promise you, before the week is out, somebody is going to throw a statement at you and say, well, can you help me with this? And Todd and I, my associate Todd Weiss and I both see this time and time again, just because we remind people that we're retirement income specialists. Now, as a retirement income specialist, we use annuities. I don't tell people that all the time right up front. I say I protect and preserve retirement accounts. I create income you can never outlive. Todd, you said, I think the last time we did a webinar, one of the largest concerns and one of the major concerns of all seniors is outliving their income. And so with that, we protect those accounts. We make sure they can't lose it. We make sure that it can create income that they can never outlive. So how do we do that? That's what Todd asked me to share a little bit about today. So I want you to think of it in two categories, okay? First off, as a retirement income specialist, we work with annuities. Annuities, if you look up IRS publication 598, it is the government's publication about individual retirement arrangements, actually is what the IRA stands for on publication 590A. In that publication, they're going to use the word annuity almost 50 times. And so you've got the government saying that annuities are the method to protect and preserve retirement accounts and to create income during retirement ages. And the Social Security is never enough to live on, so we need something to supplement that. Well, what is it? Well, we've got the 401ks. Well, the 401k doesn't create income. How do we do that? We transfer that into an annuity, And the annuity then will protect it, grow it, and then it will spit out income in the same fashion that they put it in. They put it in small increments. It's going to come out in small increments. So there's a key factor, and you need to understand this distinction. An annuity by itself is a continuous form of payments. You understand that Social Security is an annuity, right? You have put money in over your lifetime, and now when you hit 62, 66, and some change, or 70, you're going to turn on your Social Security. That's going to give you a lifetime payment you cannot outlive, and there may be some actual incremental increases in your income throughout your life. That is an annuity payment. It is paying income over your lifetime. Now, in a base annuity, every annuity contract has what is known as annuitization. I took 100,000, I grew it to 200,000. The insurance company says, if you'll give me that $200,000, I'll pay you some amount of money for the rest of your life. I can pay it on your life only, lifetime only, or I could do life and some type of insurance, like you want it to go for 20 years, you want it to go for 10 years, or maybe you want to take it and say, I want it to go on my life and my spouse's life. So now we pay on 2 lives. So every time we add an insurance factor to that, it's going to dumb it down a little bit. It's going to reduce the payment. So if I was going to get $1,000 a month, now I'm going to get 800 or 700 or 600 or 500 because I put a guarantee on it. If it's guaranteed to pay for 30 years or 20 years or 10 years or on both of our lives, then that's expensive. So they've got to reduce the payment amount. That's built into every annuity contract. Now, I've been doing this for 20 years. Let me think of all the times I've seen annuitization. 0. No one takes and gives money to the carrier and gives up total control anymore. They used to because they didn't have any other options. But now when carriers started looking at this, they determined that it would probably be good if they could offer a benefit to the client that looked like annuitization but wasn't. And they could guarantee income for life at a lesser amount, but guaranteed so they'd never outlive it. So we have our base annuity contract. It's a fixed indexed annuity contract. It has a fixed account. We trade the fixed for indexing because we know indexing historically always wins, right? So we know that in the S&P, it wins 70% of the time. With the new SILAC strategy that we love, the global Barclays Atlas, and we're seeing more and more of these global strategies added to carriers like F&G or Athene. They add some of these global strategies in there. The best one right now just still happens to be with SILAC on this Barclays Atlas 5. It's global. We know that 80% of the time it's going to get an interest credit, okay? So do you want to leave it in the fixed account where you're only going to get 1 to 3%? Or do you want to trade the fixed account for an index option that will allow us to do maybe 1.5 to 2 times, 3 times, 4 times more in interest credit with that global strategy or even the S&P. So now, and again, I'm helping you understand the distinctions here. You must not mix these 2 columns together. We're talking the base annuity contract. We're growing the account. We put the money in, we grow the account. But now, if we want to create lifetime income, we must do an add-on to the current policy, or the only thing we've got is annuitization. We don't annuitize anymore. So now we're going to put an income rider as an add-on to an annuity contract. Yeah, one of the things, if you've been part of any of our trainings in the past, we always teach and we always like to remind you that income is king, but income is expensive. The largest part of the U.S. budget for 2019, 2020, 2021, the largest line item on the U.S. budget is income, Social Security, those payouts. Pull it up, Google it, you'll see the pie chart. You'll see that the largest expense on our economy is income. Income is expensive. That's why pensions went bust in the 70s, because they had promised these deferred compensation plans to all the war veterans when they came back in the Industrial Revolution in the 40s. And then it got to the 70s, they couldn't afford it anymore. They're flipping upside down. And so ERISA came about to protect those retirement accounts. Income is expensive. So now if we're going to put a guaranteed lifetime income rider, an add-on, just like you have riders on any type of life insurance policy, you put a children's rider or health rider, whatever you put on those riders for a policy, it's an add-on. Base annuity contract, add the income rider. Now the income rider, because it's going to guarantee income for life, may have a cost, okay? And probably 95% of all of your contracts, if you add an income rider, you are going to add a fee. That fee is going to range anywhere from 0.75% up to maybe 1.5%. That's kind of the range of prices for an income rider. There are a couple that have free income riders. American Equity used to have one. National Western used to have one. American Equity may still, but they've reduced it down, so it's almost a non-factor anymore to use it. National Western, I think they've done away with theirs now. They've added a fee to that. The only one I'm aware of right now that doesn't have a fee on the income rider, that actually is worth something, would be the SILAC contract. So we really do like that one because of the global strategy, the upside. But here's what we're doing. If you put an income rider on this contract, let's assume that you're buying it, okay? So you buy this guarantee and you paid, let's say 1%. They'll usually charge the fee on the income rider account. Let's call the income rider, if you will, for me, call the income rider account fake money. Let's use Nassau Re as one example. Nassau Re has a income account. They will give you, if you put $100,000 into the account, they will give you a 30% bonus for the purposes of income. Now, that's a great marketing strategy. Right now, if you've had somebody who lost money in the market, you can say, you know what? I know how important income is during your retirement years. And I've got a carrier that I work with that recognizes that seniors need every penny that they can squeeze out of their accounts for guaranteed income. And right now, I've got a carrier that will offer you a 30% bonus to help you recover some of your losses and get you back on track towards meeting your retirement income needs. Would that be helpful for you? And so there may be a time where you use that. And the benefit to what we do with something like Nassau Re, they do allow us to turn income on in the first 30 days. Now, I have ways that I work around that in most cases, because if I'm going to use SILAC, I just withhold the money for the first year, turn on the income in a year or two, and it's going to win in that kind of scenario. But I just want you to understand, I know all the products, I know all the riders, I know how they all play out. So we plug in different scenarios. When you call me or you call Todd Brauch and ask him for help, we're going to look at the scenario and we're going to say, okay, this is what fits best for your situation, whether it's going to be, an Athene or an F&G or a Nassau, whatever, we don't care. We're going to plug in, but each one's going to be the same. Base contract, add on the income rider. Now, that income rider is, I'm just using Nassau Re for numbers example, that income account went from 100 to 130. Well, now we're going to charge you an income rider fee and we're going to charge it of 1%. Well, guess what the 1% is going to come off of? Not the account value, but the income account value. So 1% of 130,000 is $1,300 coming off of real money. They can't charge fake money for that, right? So now your account was 100,000. It could be 98.3. Is that right? 98.3 or 98.7. So you took off $1,300. So now your account, if you get some interest credit this year, then that could come back up to 100, 101 maybe. But that's intended for income. It's not really a great growth contract. So we're looking at it for the income purposes. It will grow some, and maybe it will help offset that fee. And maybe that's the benefit of it. So it kind of maintains your 100. But I don't care about the account value in that one, because the most important part was maximized income. So 130,000, and that is now times a payout percentage. Now, I don't want to confuse you, but if you're jotting some things down on this, here's the key parts about an income rider. They don't always have a fee, but they often have a fee. If they have a fee, it always comes off of the income account charged to the real money. So we have a fake monopoly money account to create income. And what does it matter? If I don't care if I have any money for my kids, but I care how much money I have to live on, if I turn on that and this account value starts going down quickly. If it was for me to live on and maximize my income, this actual account value becomes immaterial to me. I've got to have the most money to live on. So I'm maximizing that account. So if this goes down, then fine. But if I've lived 10 years and taken out $30,000, then there's a real good chance I've got $70,000 to pass to my beneficiaries. And that's the benefit of adding an income rider to an account. I keep control of the money, and I still have a death benefit if I don't outlive all of my money that I have deposited into this account. So I've got the account with my annuity. I've added the income rider. It could have a bonus on it. It may not have a bonus. And so the difference is if we have $130,000 in my account day one, here's the key factor to income riders, not how big this account is on the fake monopoly money. The important part is the payout percentage. So if I'm paying 4% of 130,000, or if I'm paying 5% of 100,000, which would win? Well, I don't know. So let me do some math here. Let's take my calculator. 130,000 times 4% equals $5,200. But if I take 100,000 times 5%, it's $5,000. Do you understand why payout percentage is king? So it matters sometimes on early processes what I have to do. Now, the key to this is you don't have to know these numbers. You don't have to even care about these numbers. I just want you to have a handle of how this works. When you get ready to run this scenario, you call Todd Brauch, call Todd Weiss, call Rick Rose. We'll run the numbers and then we'll go over this. What I'll do is I'll pull up an account, I'll show it to you, and then we'll do a Zoom so that you understand what this looks like for you when you're presenting it to your client and how to present it. Okay, so I want to show you, I'm going to take a minute. Todd, now I ran through that in kind of a quick fashion. Are there some things there then on the income account? Because I'm going to show an actual illustration, show some other benefits of what the income rider will do. But from just a standpoint, you've got the account, that's the annuity. We're adding on the income rider. There may or may not be a fee. Most of them will have a fee, but the one that we like and use a lot is SILAC. It doesn't have a fee, and I'll show you how that works as a roll-up. Oh, one other thing before you answer my question, Todd. The income riders, when we buy that for a fee, we usually are buying a guarantee roll-up amount. Let's back to Nassau Re. First day one, right out of the gate, it gives me 130%. So I've got 30,000 added to my account on a $100,000 case. My income account went to 130. The next year, they give me a guarantee of 7.5% simple. So another $7,500. So now I'm at 137.5. They give me another 7.5% simple. So I had another 7,500. Now I'm at $145,000 in year 3 for my income account. That's a good number. Now, if I'm deferring on the other side, then it can grow up 14% per year. That's what you buy when you buy the income rider with many of the carriers. If there's a fee, it means that you probably guaranteed some minimum amount of roll-up. With National Western, their minimum roll-up was 5%. With Athene, I think they had some 5, 6, and 7, depending. American Equity had a 3% that was free. Then they had a 4 or 5 that you could buy with the income rider fee, and you would get that guarantee. And what that does is if someone says, I can't take any chances, I've got to know exactly what my budget number is going to be in 3 years, then I'll probably pick one of those guaranteed contracts as opposed to SILAC, because SILAC won't give a guarantee, but there's no charge for it, see? So if our indexing works, then that's my account value. That's what my income is going to be based off of. But with these, I get these hypothetical numbers that will be what I'm buying with that income rider charge, okay? So when I pay that 1% per year, Well, it bought me a 30% bump. It bought me a 7.5, a 7.5, and then 333. Or on the other side, they've got one that's given 14 for 10 years. 14, so you're getting 14,000, 14,000, 14,000 for 10 years. You know that in 10 years, 100 became $240,000 guaranteed. And then that's my payout percentage, whatever that is. I bought that with that income rider charge, okay? So that's what I want you to understand. Now, there's a couple other benefits I'll show you on the illustration in just a minute. But Todd, do you sense anything that I missed on trying to explain the distinction between the product and the income rider, the charge, and the monopoly money that creates for income?
No, I think you're spot on. I think, another thing too, I know people are kind of concerned about is kind of how they're going to pay for long-term care as well too. How can we factor that in as well?
Perfect. All right, that's a good segue for me. Let me pull up my screen then. I'm going to do a screen share here. So let me see if I can do this. All right, Todd, is that coming up?
Yes. Yeah, I'm seeing your desktop right now. Okay.
All right,
yep,
great.
Yep.
Yeah, SILAC portal here.
Yep, you bet.
All right, so let's just run it, and I'm going to use this one because I know it has the income or the impairment benefit. We have most of the carriers now have what we call is an impairment benefit. Let me show you what that looks like. So let's just run a sample illustration here real quick. So we've got valued agent. We'll usually put that in just because we don't want to misspell a name or something. Let's get y'all up. Is it okay if we do a Nebraska one there, Todd?
Sure, that'd be perfect.
All right. If you've got clients in rogue states like Missouri, California, Texas, rates would be different, but not the product, and it's basic here. All right, so let's just call it a 65-year-old and turning on income at 70. So let's take $100,000 and let's call it qualified. It's our work account money. All right, we are choosing the Barclays Atlas, and if we have time, I'll show you that. I don't want to take too much longer here for y'all today, but let's just turn on lifetime income. Hopefully around 70 there. We'll just project it. That number is immaterial to what we're going to show you here. Give this a moment to think, and the moment it is going to say, I'm done thinking. There we are. I can allow that. All right. So here's what a basic illustration is going to look like for you. It's got your contract information. Let me see if my pen will allow me to mark on this. All right, so basic contract information showing the the surrender charges stuff here. This is, and if I was showing this to a client, I highlight some of this information. But here's one of the charts for the income rider. Okay, this has a built-in income rider. Now the unique thing about this one is there is no charge for this income rider. Okay. It's a free income rider, but it will not give you a guarantee of a roll-up number. It's going to base it off of the indexing. We just believe that the indexing works well enough in this to be worthwhile. So we have a client that is 65 right here. We're going to try to turn on income around this age. So if it hits at this age, it really won't matter. But this is saying that my payout percentage, this is what's key. If that number is big, but the payout percentage is 3, then it doesn't help me. If I have a payout percentage in this one, it's going to be 5.25 or 5.35, depending what year popped up based on how I touched the strategy there. All right, so now we're just showing here that we chose this strategy. It has 140% participation rate. It has a fixed rate, and remember, we trade the fixed rate to try to get this because it wins 80% of the time. So that's a good number for us. We're getting 140% of whatever that strategy does for us. We have the minimum guarantee. Okay, so this is showing age 70, so it did work. The payout percentage was 5.25%, and that was based at age 70 at 5.25%. So of 100,000, that would give me 5,250. Now, we have this little column here, and this is where it's real important for you to understand the impairment benefits that are on most contracts today. Most annuity contracts now have in place a couple of factors. One, if you cannot perform, in this case for SILAC, 2 of 6 activities of daily living, right? The ADLs. Then what they will do is they will double your income for 5 years. Now I'm going to explain this, and then I'm going to complain about it so that you understand my reservations with some of this. $100,000, mom goes into a nursing home. She's not even in the 2 of 6 activities of daily living. Maybe if they are at home and someone can come in and care for them to take and double the income from 52 to 10, 5, almost $1,000 a month. Maybe that helps a little bit. You can pay somebody to come in and help you if you're the sister taking care of the mom while the brothers are away. That was the situation with my family. So mom's at home, my sister's caring for her. So we could double the income and give her this amount. Now it's her money, so whatever her account is right here, that will come off of it. Okay, so we've got to take that money out of the real cash money, but it's guaranteed to go for at least 5 years, because most impairment only lasts for that period of time. When my mom finally went in a nursing home, she was there for 14 months before she passed away. 2 years is about the expected time in a nursing home, and maybe a little bit longer with the impairments. So I think my mom had to have care for maybe a year before she went into the home. So maybe the income doubler would help. But guess what? Her first year of nursing home cost us as a family about $90,000. Okay. So here's the other benefit to almost all annuity contracts. If my person is in a nursing home confined for 90 days, then they have access to 100% of their money. That's pretty standard across the board for you. Now, some will vary, so just know that you'll want to check that out and read those details. And that, I'm not sure, that could actually be in this. I forget where withdrawals, how they're set up, but read through. Right here is talking about the activities of daily living. But I think that it may be somewhere else in the contract that it talks about the access to your money if you are confined. So anyhow, just know that there are additional benefits. It's in your brochures of your contracts. And if you get down to that, if you're selling this for long-term care, well, this is probably about as good as we get. The income doubler for impairment. Pretty certain that's with F&G, National Western. I think theirs is confinement only. I don't think you get the doubler if you're not confined, but if you're confined, you can get 100%. Athene, I think, is like that. So just depending on the carrier, we'll check those fine details. If you're selling it for that reason, we call this the wellness benefit. It's going to give 2 times the income, which is this column right here. So 2 times the income for up to 5 years for impairment, just 2 of 6 activities of daily living. Right up here at the top that I wrote that. So 2 of 6 activities of daily living, and you can double your income for 5 years. After that, if you're still living and they're still needing the income, then it just reverts to this. So then you'd have this for the rest of your life, no matter what. All right. Now, I did this one on the guarantee page. This rider has no charge, no fee. So if we go to the current projected values, if you look in this top right-hand corner right here, if you can see where I'm marking red in this right corner, it's showing a projected rate of return of 9.7. They based that down here on this, saying the most recent 9.7, but the lowest was 8.6. The highest was 11.6. So what if you cut this in half and call it 4? So somewhere between 4 and 11. That's still pretty good, isn't it? And that's cutting their worst case scenario in half. So if your client can get 4 to 11% returns, then project in a smart way, but they're saying 9.7 because it's hitting 80% of the time. That means we'll have about 2 zeros out of every 10. So let's go down 10 years. Oh, 1 0, 2 zeros. Look, and look at the credits: 13, 12, 15, 17, 0, 3, 10, 0, 15, 10. So there are strong credits that you get because it's 140% participation rate, right? With no cap. So that's why you can get these high numbers in here. So it's really strong for credits. That means my account's grown. Now that means my income number is now 9,000 right here instead of 5,000. And then over here, when it doubles, it's going to become 18,000. Now, maybe that helps, maybe it doesn't, but the benefit is if they get confined for 90 days, I go get the full cash value out of the account, and I just take $183,000 out. I pay for the care with that, okay? Now, remember, you can have the same contract, and it can have no income riders whatsoever. And it's just going to be a base annuity. It would look just like this. But with this particular one, they don't charge a fee to give a lifetime withdrawal benefit or a wellness benefit. But they don't give you a guarantee roll-up right here like that Nassau Re did. You have to trust the indexing is going to work. And if indexing works as it has historically, then you're going to have real cash, not a hypothetical monopoly number. And so you have no fee for that. And then this comes off of this. But what if I took out 9%, but I got a 10% credit? My account goes up. My paycheck goes up. My income doubler would go up, all based off of indexing that works. So that's why we do have a tendency to lean on SILAC right now. When a better contract comes out, we'll tell Todd and tell y'all, and we'll try to shift things that way. And like I say, if they had to have income in 30 days and they cannot live on a hypothetical indexing number, then we would look at this page. This page is all about the guarantees, right? So we would say, okay, you can take the guarantee on this column, but it's only going to be 5,200. So if you had to have a guarantee, maybe then I've got to go to Nassau Re as a carrier or FG as a carrier. I'll go to a different carrier because you've got to have a guaranteed number. This one's not going to give you fake money. This one's going to give you real money. And if we can't say that the real money can be anything on a guarantee. If the market's down for 5 years in a row, but Nassau Re guaranteed me 30, 7.5, 7.5, 3. Well, if that's what you need, if that 51% is better, that means your 100,000 is 151,000. If that's better than you projecting on this at 100, and you can't stomach waiting to see what in 5 years, well, that 173 sure sounds better than 150, right? But this is not guaranteed, and I can't promise you that's what it's going to turn out like. So if you need the guarantee, that's what we do. But they all work similar. Some just charge a fee, some don't. This one doesn't charge a fee, but the basis of them works the same. Income rider growing, income doubler available, 2 times the money for up to 5 years for impairment. Long-term care benefit riders on annuities have basically gone away. And part of the problem was people bought a inferior annuity to get a lifetime benefit, LTC benefit. And then if the client didn't qualify, then the client was stuck in a terrible annuity with no long-term care benefit on it. Underwriting and all those things, it was just too hard. So most of those contracts, as Todd and I were talking before we started this webinar, most of those contracts have just gone away and we don't even see them anymore. All right. So that's kind of the basis of what the writers do.
Hey, Rick, can you go back to that? We have a question on that illustration.
Okay. All right. Can you still see it?
No.
Okay, then I must have stopped my screen share. Let me go back. All right, so what's your question?
So basically the question is on that illustration that you did. If you can pull that back up. Okay, yeah. So they have a question, and so if they were to do the wellness so we're looking at age 73 and the wellness withdrawal, and they qualify for it and everything like that. So they're getting 18,576. So how about if they pass away in the next year? So what is the beneficiaries going to get then is the question. And also the same thing if they do the lifetime withdrawal instead of the wellness.
Remember that with this particular account, this is the income we take out. It comes off of my real money account. There is no fake account here. So if you die right here, you've taken out $27,000 for a total benefit of $195. You put in 100, right? And your death benefit's 183.
Got it.
This is whatever your account value is. If you die here, there's your account value. That's what goes to your beneficiary. You die down here, well, that account kept growing. Now you're at 267. You've taken out 91,000. Here we've taken out 105. My death benefit's 253. My total value on this contract's 359. So I could take this money out. Now, that really didn't factor in the doubler, but if it's 2 times the money, of course, that number would be less because I'm subtracting 2 times the amount, right? So I'm taking 14 instead of, I'm taking 14 instead of the doubler amount.
Got it. Okay. Perfect. Cool.
Okay. So those numbers, and again, when I turned on income, it will only go out to 5 years before it stops that on the doubler amount. And that's why this number just starts matching the income account number, because it has reverted back to this once I run out of my 5-year time frame.
Got it. Cool.
And that was the 5th year was right here.
Yeah, got it. Perfect.
So now I'm taking 10,000 out. Now it grew, so I'm taking 11. It grew, so I'm taking out 12. It grew, so I'm taking out 14. 14, it didn't grow, but it grew again, 14.6. Now it grew again at age 95. I'm taking out 21,000. But my total benefit now is 767,000 on a $100,000 deposit.
Yeah. And still the beneficiary gets some money out of the contract compared to, like we were talking about earlier, standalone long-term care policies as well too, where you don't, if you don't use it, you don't get any money back unless you've got the return of premium, which that's kind of, rare anymore too. And also more expensive because you got to pay for it as well.
The return of premium is always minus your withdrawals.
Yep.
And so if you had a contract, it would probably look more like this one, where your account did not grow because you were taking out larger amounts of money than you were getting credited to your account.
Mm-hmm.
So my account value eventually is going to zero out.
Perfect.
Because I just don't have that much money in the account, and I'm taking out larger amounts of money. Well, then that's going to hurt me in the long run.
Yeah.
So it eats up my principal quicker that way. So my account goes to zero faster and there's less for my beneficiary. But we believe with this one, with the actual potential of a growth account, you could still have some money for your beneficiaries. And keep in mind, you could pull all of it right here at 191. If they've been confined for 90 days, pull the full 191. There's no surrender charges, no penalties whatsoever. It could happen right here. Even though it's a 14-year contract and you're in year 4 you can pull 173 out with no surrender penalty if they've been confined for 90 days. So this is your full value to your beneficiary to pay for that nursing home if you want to. And your contract just ends.
Yeah.
If you take advantage of this and this, the income and the doubler, then it still starts subtracting from my account. And I keep this in place, growing and subtracting through the process. And then I have more for my beneficiaries, but I didn't have as much to spend on care for my patient that needed it.
Yeah. No, it looks good.
So that's
awesome.
Question.
No, it's a good question. Yeah. I think, yeah, that's all that we have for questions in that. But no, it's a perfect, I mean, it's a good, way to, have income for you too. So, especially, we run into situations where, husband and wife, and one of them passed away, and they were the one that, had the bigger Social Security check or whatever, and then the spouse gets half of it and everything. So it's another option to dig into the lifetime in withdrawal rider as well too, to get some more income for them.
Yeah, and that doubler can be just what they need if they're at home and mom's taking care of her. Maybe she needs somebody to come in. They were living on this and it was fine, but now all of a sudden she's got care, so she wants to invite someone to come into the home once a week. Well, then maybe an extra $9,000 would be beneficial.
Yeah, definitely.
So that could help pay for care while mom's still there, but maybe give her a break 1 or 2 days a week.
Yeah, no, definitely. Yeah, perfect.
And so that's how that can work. But if they're going to go into a nursing home, then after 90 days, maybe she needs all of the money. So she stops this, trades this, gets this amount, pays for the care. And then still after 1 year, if he passes away, she might have $70,000 left.
Yeah.
And then you could create some income.
Yeah, no, definitely. No, it's good. It's a good, some good options here for the client. It's awesome. So good.
Yeah. And so it's not underwriting. The only question they ask is, are they in a nursing home at the time of issue? And so if they are not, then it goes in that note right here. Most of these don't come into effect until the 3rd year. So the client has to have some health going in, or if they go into a care facility, you can't trigger that option until the 3rd year.
Yeah.
And that's you can see the income doubler here. That's in most of these contracts. They put a little bit of a caveat. They're trying to think that these are healthy clients that they're dealing with to start, and we're not just trying to get extra benefit from the carrier unnecessarily. Well, so it's not underwriting, but it's a little bit like that guarantee issue final expense plan, right? Yeah, I think they'll live a couple of years. Let's go put them in it. Not the best deal in town, but it's still a good help. And so remember, when they go into the care facility, the key is, do we have 100% access to our money if we need it? That's probably the bigger benefit. Like I say, we spent almost 90 grand for my mom that first year. So $18,000 wasn't putting a dent in that, right? So you got to have access to that money, or if they're okay with it, then you just kind of cover it that way. And so, but that's the keys to it.
Yeah, no,
right?
definitely.
Any other questions?
I think that's all the other questions we have, Rick. No, it's a great option, and it's there's options in annuities to help individuals out with their income, and as well as help them if they cannot perform 2 of the 6 ADLs in that. So no, I appreciate it, Rick. It's awesome.
Again, my focus and my goal to help everyone remember, the annuity is one thing. The rider, which is literally what it says, it's a rider. It is an add-on to a contract. Some contracts, like the Nassau Re, you can't buy it without that, so you automatically have that fee in there. With SILAC, we could use the Teton or the Denali, but I would always use Denali because it has the free income rider and has better caps on it. And if they pay the same commission across the board, what's the matter? Let's use the better growth. The one has better liquidity, one has better growth and better income. I always deferring. I probably write probably 99% of my contracts I write will go in the Denali over the Teton because it's just a better benefit for the client.
Yeah, definitely. Well, hey, Rick, as always, thanks for your time today. Really appreciate it. And again, annuities, there's, even if you have clients that have CDs at the bank or savings accounts or whatever, you know what the interest rate they're getting. They're like getting, what is it? I haven't looked at it this week or last week, 0.5 or 0.25%. And also putting into an annuity, it's tax deferred as well too. So they're having their money work for them much harder than a CD at the bank because they got to pay taxes on the interest they get. So basically that 0.5 depends upon what tax bracket it is, maybe 0.25 you're actually getting from that annuity as well too. So give us a call here at Senior Insurance Marketing, 877-800-3080. Be happy to help you out with a client that you're working with, or if you want to understand more about annuities, do a one-on-one. We can always bring Rick and Todd on board to do a one-on-one with you and your team as well too, just so you get a better understanding for annuities. And also, so one more time, Rick, what's the buzzword to say? You're an income retirement.
Hi, I'm Rick. I'm a retirement specialist. I'm here to talk to you about your MedSup, your Med Advantage, your hospital indemnity, your life, your final expense, your cancer, your dental plan, your Grubhub to check your dog for fleas. I'm Rick, the retirement income specialist.
Awesome.
I do it all.
One call does it all. Exactly. So give us a call here at Senior Insurance Marketing. Again, Rick, thanks for your time. Greatly appreciate it. And we'll be happy to help you out. And so you can help your clients and so they can don't have to worry about outliving their income. That's a huge worry factor these days as well. So again, give us a call. We're here to help you grow your business. Take care, everyone. Have a great day.